Welcome and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. In the show, we cover a broad range of topics that cater to both CRE newcomers and industry leaders alike. I'm your host, Shanti Ryle, Director of Content Marketing here at Crexi, and today we are very excited to sit down with none other than David Auerbach, Chief Investment Officer of Hoya Capital. Before we dive in, a little bit about our guest. David Auerbach has been in the REIT industry for over 25 years, and before becoming Chief Investment Officer at Hoya Capital, he was the former Managing Director of Armada ETF Advisors. He's the publisher of the Daily REIT Beat newsletter, which we'll get into, I'm sure, a widely followed industry publication that covers the publicly traded REIT sector, and is also a consultant with 4,800 partners, which is focused on corporate access in the REIT industry. David spent time working with World Equity Group in institutional securities tradings, and in December 2018, he departed Esposito Securities after 6.5 years, where he had helped to build out the REIT real estate platform with institutional investors and equity REITs, plus worked with ETF issuers on seeding, relationship building, and order execution. Lots of projects there. Prior to joining Esposito Securities, David spent 11 years at Green Street Advisors as a vice president of institutional trading, handling REIT order execution and sales, trading on behalf of institutional clients, hedge funds, pension funds, and other investors. He has been quoted by Bloomberg, Wall Street Journal, Financial Times, REIT.com, and Globe Street, just a couple, casual magazines you might have heard of, among countless other real estate publications. And he's been a featured guest on such networks as Yahoo Finance, TD Ameritrade, and Bloomberg TV. In his free time, if you can believe he has some, you can find him attending as many Phish concerts across the country as he possibly can attend. David, first, welcome to the podcast.
Thanks, Shanti. It's great to be here.
We're very excited to have you, but I got to ask first, how many Phish concerts have you been to?
As of this moment, we're at 240. We got a lot more to go.
Whoa! That's impressive. Where is the craziest locale you have traveled to go to said Phish concert?
That's a good question. Either to the Gorge in Washington, which is in George, Washington, is the name of the city.
Yeah.
Or
I love the Gorge. My husband has played there before.
Your husband has played at the Gorge?
Yes. He's a musician.
Okay.
This is way back. We'll get
I'd
into
like
it.
to get more into that. Seeing them at Red Rocks is a very famous concert venue. Maybe going down to Mexico and seeing them on the beach. I have not had the pleasure of going to Europe or Asia or any of those places that they played many, many years ago. So
it's on your list if they ever go there.
if my spouse will permit it and the budget allows it, I would love to do that.
All right. Well, we'll try to make a case for you when we're offline talking after this. So, David, I know we just covered your very impressive background, but I'd love to hear about your career path, lessons learned in your own words. So, how did you first get into the REIT space, and what about it really glommed onto your attention such that you've been in it now for over 2 decades?
How I got into the space is just by random chance, actually. That was by luck. I started out as a retail advisor. My father is a former CPA, and he used to have a tenant that rented space from him. The guy was a CPA, but he was also a financial advisor. There's practices where CPAs that are managing, taxes on behalf of their clients are also able to do investment management for their clients. And so because his partner knew that I wanted to be on Wall Street one day, he gave me my foot in the door. And when I graduated college, I went and worked with him. He got my licenses. And I'll never forget, I was about to have my first business lunch with a prospect. And I told him, hey, I got a lunch with this prospect today. And he's like, that's great. You can't have lunch with the client. And I go, why? He's like, look, you want to network and build a book of business. That's on your time. That's not on my time. You're mine during market hours. And if you want to build anything, that's on your time. And I was a little annoyed that, we were always taught that networking is a 24/7 gig. There is no set time to network. And I told him, they reached out to me. They want to have this meeting. And now I have to go back and tell them, sorry, I can't visit with you. You got to do it on my time. And he's like, yeah, my shop, my rules, and that's what it's going to be. And I said to him, I go, that's the stupidest thing I've ever heard. Well, P.S. 24 hours later, I got fired. And back in the day when the newspapers used to be a very big booming industry, the daily newspapers would have classified sections, job ads every single day. And so in the first week of me being unemployed, I remember looking at the Dallas Morning News classified section, and literally it was 2-inch line, 2 lines, 2-inch font, got Series 763, call this number. And I called the number, and it wound up being for the trading desk job at Green Street, what's now known as Green Street.
Yeah.
So I started there in March of 2000 on the day that the NASDAQ officially crashed, like at the official top of the tech.
Like the day.
The day was my first day. And
ooh, good thing you had that contract signed already.
Worked out well. I'll never forget, as I walked in my first day and I was meeting the folks and getting ready to set up, the second youngest person at the firm, who was the head of sales, he came up to me. He's like, David, hey, great to meet you. By the way, don't get comfortable in this seat. I'm like, oh, great. That's what I want to be hearing, as I've been in this office less than 10 minutes. He's like, look, you're entering the world of REITs. And, this REIT industry, it's not going to be around 5 years from now. This is a dying industry. So, consider this as your stepping stone to your next opportunity within a couple of years. Well, here we are over 25 years later, and the REIT industry is beyond thriving, that when I talk to this person every few months, I'm like, how's that 5-year window working out for you? Do you remember telling me that?
They can't live it down.
I will never let them live it down. So to answer your question, put a bow on it, the REIT industry that I grew up in March of 2000, pre 9/11, basically looks nothing like what the REIT industry does today. And I know we'll get into it, but you're talking about an industry that has now evolved into 20 different sectors, 200 publicly traded companies, 50 different exchange traded fund type products, public, private, everything in the middle. It's just an industry that's really grown on hyper steroids times 100.
Yeah. Yeah. And we will get into the weeds, definitely, of the evolution you've witnessed since it's been there. Now, for comparison, how many were around when you got started?
I'd say back then, when I first started at Green Street, there was less than 75, 80. And really of those, I talk, like there was the bread and butter sectors, office, strip center, malls. Like those were the stuff that was really back and popular then. Residential apartment REITs is another one. But then there was mortgage REITs and, some other stuff. And so just like today, it was mostly equity REITs with a handful of mortgage REITs, some unlisted private stuff, but there was no B REIT. Like there wasn't a Blackstone REIT vehicle that was as prevalent as it is today. There was other non-traded REIT platforms, but nothing again like what we're seeing today in today's markets.
Yeah. It's exciting stuff. So, in those early years, you were told, don't get comfortable. This is a dying industry. Now, I'd love to know, were there early moments, maybe in those first couple of years, where you were prepared to be like, okay, I'm going to go somewhere else? Or maybe you weren't. Maybe you were bullish, like as soon as you got into the industry. But do you have any key moments where you realize, oh, wow, like this industry is a career for me? And what about it to you do you think you were most captivated by?
So first of all, it starts with people believing in you. When you have mentors and leaders that help pave the way for you to be successful as you're starting out in the business. Like I remember my boss said to me, again, on my first day or when I got hired, her words, literally word for word, kids your age don't get the opportunities that you're being given. 22, 23-year-old kids don't get to go sit on an institutional trading desk. You've got to work your way just to be able to achieve that junior trader status. And again, living in Dallas, Texas, it's much different than being on a trading desk in New York City or San Francisco or one of these, real modern financial mecca markets. Dallas at that time was not considered that. So I didn't know. As another example, Dallas is known actually, like for bad ice storms that come through in the winter. And, like when the first storm came through, I'm like, so what happens? And she's like, David, just because there's ice in Dallas doesn't mean they're closing the New York Stock Exchange today. You've got to be here. Your job is to be here. Well, I live 15, 20 miles north. What am I supposed to do? figure out a way to get to the office. You've got to be here. Your clients expect you to be here. And, realizing how important my role was on behalf of my clients or Green Street's clients to work with the exchanges, executing trades, crossing trades, building relationships. As a 22, 23-year-old kid, when you're not really taking on account responsibilities versus a couple of years down the road, you've got a book, you're talking to these people 5-10 times a day, you're trying to build new relationships, generate new business. You don't realize how much goes into it. Where then if you go away for a couple of days to go to a Fish concert and you miss out on that trade because your client's favorite trader wasn't there to take the call, they're not comfortable working with other people on the desk, or they don't have that same relationship with other people on the desk that they do for you, that's kind of when I realized that I've got something here. Because clients were reaching out to me, because clients liked working with me, talking about stuff that wasn't market related, frankly. Those are the best relationships, when you could talk about stuff that isn't focusing on business, if that makes sense. That, I think really quickly, when I finally got the hang of it, and my boss said to me, it takes most people, a year before I'll even let them answer the phone to start taking orders. And within 3 to 6 months, I was already taking those orders and doing that stuff. So that's when they realized, okay, this kid's got something. He's got the personality that's an asset for this business. Let's nurture those skills. And so that's why I was lucky to be there for about a dozen years, taking on more responsibility, working with bigger accounts. It was a whole different universe. Like when I went over to Esposito, working with ETF issuers, because even though I was there for 6.5 years, I saw over 150 people come in and out of the door, hired, fired, resigned. And it's very difficult to build relationships with folks when the bench is consistently turning over every few months, every year or so. How does a client build that trust with their traders, their bankers, their partners, when they don't know who's going to be answering the phone next week because that person may have already been replaced?
This is an interesting kind of sidebar, but I'm curious, and we can maybe get into this when we talk more about technology later, but in this more like social media connected world where it's more so important than ever that people know the people behind who they're doing business relationships and business transactions with, I wonder if, did you see people following their trader, their person, to different banks, to different institutions?
Oh yeah. Yeah. There's definitely clients that would go along if you move shops. There's obviously rules, quiet periods, non-competes, that type of stuff. But that's, again, it boils down to the relationship where it's, okay, I can't talk to you for 6 months. Great. I want you to know that on 6 months and 1 day, I've already got your name on my calendar to ping you. So, obviously it's a little bit different because there was no social media back then. I remember LinkedIn was prevalent back in the early 2000s.
Yeah.
But it's not like the
2004, right?
But it's not like the LinkedIn that we know today.
Yeah.
Twitter back in 2004 versus Twitter 2025. I mean, completely
totally different beast.
So, I'm not trying to give myself any credit or anything, but thinking about, there's not a day that goes by that I don't appreciate the foundation that Green Street built for me to be where I am today. Case in point, as a trader on the Green Street trading desk, I would have never been able to be interviewed on Bloomberg TV as an example. I wouldn't be sitting here having this conversation with you today. Your job is to be a trader. You sit there and you execute the trades. That's all that you do. We, the parent company organization, we have people to sit there and do these interviews to go be on TV. That's not your job. And I was always, not that I wanted to try to make a name for myself, but I mean, I grew up watching CNBC. I grew up watching Bloomberg. I always said to myself, boy, it'd be great to get on CNBC. Love, hate, whatever your relationship is with the networks. But to be interviewed by one of those financial channels, it's almost like a feather in the cap of, okay, you have made it. You have established, you have a name in your industry. We want to bring you on to talk to you about your expertise. And I don't know how you can't say no to those types of offers. So Green Street helped make me the trader and REIT person that I am today, to the point that, many years down the road when I left Green Street, 5-10 years after I left Green Street, to have people come up to me and say, wow, I can't believe that you were able to stay in the REIT industry as long as you did. We didn't think you were going to get far after you left Green Street. It just proves how,
All these doubters.
well, again, but it's, so I understand where they were coming from though.
Mhm.
When working at a institutional trading firm like that, your trading is supplemented by the firm's research. Companies are paying the
Yes.
firms for research through trading or investment banking or whatever it is. So I didn't have a research machine behind me at
Mm.
Esposito, at World Equity Group, at Armada, and these other places. It was me putting out this newsletter that I started at Green Street 20 years ago, just to put it in front of my 20, 25 clients every single day.
Mhm.
Here's the news, here's the ratings changes, here's what you need to know. For that to kind of morph into the baby that it's become 20 years later, that it's my calling card to whatever else I do, it all goes back again to that education thing. And so
Mhm.
that's why I've had people that have, stayed with me for 20, 25 years, because a lot of the stuff that I do is still as if I was at Green Street 20 something years ago. I'm just not pressing the buttons and trading millions of dollars worth of stock these days. I'm just taking it from a completely different approach.
Yeah. Yeah. There's a couple things I want to underline there. One is the service mindset. You're not only dealing with these clients to execute the trades at the moment, you're providing them education, you're providing them constant correspondence, like touch bases, building relationships outside of it. And I mean, I've hammered home on this podcast with many guests just how important that is in commercial real
Well,
estate.
think about how much money does Berkshire Hathaway pay their broker to go out and buy shares or sell shares of Apple every single month, every single quarter. You could be
Mhm.
talking hundreds of thousands of dollars a year in commissions that they're paying out to
Mhm.
the sell side. And what is the sell side doing to earn that business? Sure, we'll give you all the banking deals, we'll give you all the corporate access, we'll do whatever you want to do, because these companies will literally roll out the red carpet to try to get as much of that commission dollars in the door that they can.
Mhm.
That's great, but then what? What happens if you screw up a trade and you're in the penalty
Yeah.
box? Well, there goes my $250,000 cash cow just went away because I screwed up a trade.
Yeah. The
Guess what?
trust is broken.
Not only that, you no longer have a job.
Mhm.
You ruined our cash cow. Well, then we don't need you on board anymore.
So that's a great segue. I wanted to ask, on one hand, in those first few years, how did you go about learning all the technicalities of the REIT world, first of all? And second of all, in that learning period, you're intense, you're starting to call people earlier than anyone anticipated you would be. Were there any mistakes you made that then either course corrected you or perhaps just were like a strong enough lesson where you're like, oh boy, I will never be doing that again? And is there anything that comes to mind?
So, yes. Let's go with the first part, the first
Okay.
question. The Green Street analysts were based in Newport Beach. The trading desk was in Dallas. So we were talking to the Newport guys every single day. Once the market closed, every single day we had a call set up with one of the analysts. Hey, we're putting out this note on shopping centers today. We're launching coverage on this stock tomorrow. We're putting out our monthly commentary, in 2 days. Here's the piece. Here's what we're going to talk about. So they were helping us to be able to translate that to share with a trader. So when you're talking to a trader, it's much different than what the portfolio manager cares about. The trader just wants to hear, hey, we're launching coverage on the stock. We have a buy rating on it, $27 price target. Here's our 3-sentence thesis about why we have a buy on it. The portfolio manager wants to see the full report, and that's not my job. That was the head of sales. That was the guys in Newport to work with, again, the Cohen and Steers portfolio managers to share what's going on. So who your audience is would obviously depend on what you're going to talk about. Okay. But the Newport guys were telling us what to say. So my job was to focus on the trading side of it because we were going to hopefully get business and build those relationships. Whereas, we have an FFO projection of this. This is the NAV. Like a lot of that stuff was over. How do I say this? As the traders, we didn't necessarily care what the NAV was on public storage.
Just what it meant.
What it meant. And, there's still a lot today, 25 years later, that I still don't know, that I lean on a lot of the smarter people to help me with it, like my partner at Hoya that, writes the research. Hey, what does this mean? Can you explain where you're going with this? So I know what I know, and that which I don't know, I lean on the much smarter folks to help me with. And that's kind of how I've done that for my entire career, because to go to part two, compliance is a very serious thing on Wall Street.
Yes.
Saying the words buy, sell, hold carries significant risks when you share that info. So, as an example, in my newsletter, I don't say the words buy, sell, hold. David Auerbach says you should go out and buy public storage, and here's why. It's not my job. I'm not licensed to do that. I don't want to do that because you've already got 25 guys that cover public storage. How many analysts cover Amazon.com? Let's say there's 60 analysts that cover Amazon. What value do I have in any capacity on Wall Street by being the 61st analyst to cover Amazon, or being the 26th analyst to cover public storage? Zero. There is no value. So I took it from a different approach, that when you say things that when your mouth writes a check that you can't cash, we can't use the word guarantee in our business, double bag, or all these things that are, taboo to say. I try to shy away from it. And I think here's why that is. We'll use public storage. I keep hammering that name. Mm-hmm. What makes public storage a buy to you makes it a sell to me, and makes it a hold to them. Who's right? Mm-hmm. And why did it make it a buy to you? Why does it make it a sell to me? And what makes it a hold to them? Everybody has a different reason. So it is not my job to say, oh, well, if you're looking for this, this is what makes it a buy. And if you're looking for this, this is what makes it a hold. It doesn't work that way. Mm-hmm. My job is, here's the news. Here's what you need to know. You go talk with your financial partners, your advisors, your family, whoever, and you figure it out if it makes sense to you. Mm-hmm. I have stories of, where trades that were done a certain way got me in trouble. That is different, obviously, than on the REIT education side.
Sure.
But we have enough examples of companies that, where research has been written, it hasn't played out the way that the research was written, and then the firms are held accountable because, well, you told me this was going to happen, and that didn't happen. And I always joke, well, if we had a crystal ball, I wouldn't be sitting here. I'd be in Fiji at my private resort.
Yeah.
Or, it's almost like the Back to the Future 2,
the almanac,
where Biff gets the almanac, and it's like, well, shoot, here's the answers right here.
Yeah.
Oh, that means, oh, wow. So buy Apple in 1998. Yeah, you're going to go through a wild ride, but you know what? Trust me, 25 years later, you're going to be so happy you
She'll
bought
kill me
Apple.
for saying this, but my grandma did buy it in the 80s, and she is just fine. She's a very smart investor.
See,
That's besides the point. That's a non sequitur. But
I was almost like psychic figuring that out. But
right place, right time.
Yeah. But I think, and that's kind of leading to where we're going. That's how we feel about REITs kind of right now, being in the right place at the right time. Today, as we're recording this, was the Jackson Hole Symposium. Chairman Powell, is the Fed cutting interest rates in September? And he's basically saying, yep, we're cutting rates in September. So don't you want to get ahead today for what's coming tomorrow? Mm-hmm. And I know we'll get into it more, but like that REITs are kind of like that sector that plays into how to play what's coming tomorrow.
Yeah, it's interesting. And I have a lot of thoughts percolating in my head about to what extent does the idea of getting ahead of the tomorrow, the thing that has been said will most likely happen, impact what actually does happen to the people who do make those moves today.
But the problem is that it's already priced in today.
True.
So as soon as it's said, the market is digested
ready to go
immediately. Yeah. So now once the Fed actually goes and does cut the rates a month from now, is it, oh man, they only did 25? Well, we priced that in a month ago, 2 months ago. Wait, they did 75? Holy shoot balls. Okay, let's go. Let's go. Back up the Brinks truck.
Yeah.
And, again, not to get too far ahead, but look, we know there's a new Federal Reserve chairperson that's coming in. We already know that chairperson is going to have an aggressive stance on interest rate cuts and policy outlook in the future. If REITs are interest rate sensitive, and if interest rates are cut, then wouldn't you assume that bodes well for the REIT /
Mhm.
commercial real estate industry?
Mhm. So before we get, into the weeds of REITs, the fundamentals of it, how they work, what investors need to know that maybe aren't familiar with the space, you've seen several cycles of the real estate market in your time working in the REIT space. What makes this moment feel different to you, if at all? And what feels familiar to what you've seen in previous market cycles?
Well, the familiar thing would be volatility. Volatility is always out there. It's very tough to invest in REITs with a day-to-day mindset when lease terms are many years in place.
Mm.
So that part hasn't changed. What is different today versus previous cycles is clearly the interest rate story. Because we're still coming out of this, even though COVID was 5 years ago at this point, people still treat the REIT sector as if it's stuck in COVID.
Hmm.
And, some of these companies, as they report earnings, still cover, let's say, high-level things that were covered during COVID, such as rent collection, tenant retention, dividend payout ratios, or, hey, our FFO has more than doubled where we were going into COVID. And why I use COVID as the example, flashback 5 years ago, pre-COVID, the REIT sector was basically at an all-time high. I mean, you want to talk about an engine firing on all cylinders. That was REITs right before COVID hit.
Mm-hmm.
COVID hits, REITs tank, interest rates go up, blah, 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 blah. Here we are many years later. The REITs are blowing the earnings numbers that they were putting up pre-COVID. So if pre-COVID was the high water mark and the sector is now blowing away those results, but yet the stock prices are down 30, 40%, dividends haven't fully caught up like they can, this is something that we, again, getting in today for what's to come tomorrow. We share a statistic that the REIT industry has underperformed the S&P 500 by 50% over the last 3 years, which is unprecedented in market cycles. So something has to give. Either the REITs have to rally, the S&P has to sell off, or some combination of both. And so with REITs still trading at that discount, but starting to pick up some steam, we could see that sentiment turning. And again, as I said, if the Fed cuts interest rates, what happens? The 10-year Treasury comes in, the Fed funds rate comes in, the REIT yields look more attractive, and then boom, now you've got a whole new investor base that gets excited about the sector.
Sure. Yeah. And I'll be interested in, again, we'll get into the technology of it all, but given how heavily tech companies weigh in on the S&P and given how very affordable it will soon be to start your own tech company because of AI.
Well, let's go into that real quick. I don't want to jump in, but
sidebar.
Well, no, this is a very interesting topic because the tech REITs make up like 25% of the REIT indices that are out there.
Will you quickly explain what makes a tech REIT a tech REIT?
Sure. So a cell tower, a data center REIT, the infrastructure that basically helps us live our day-to-day lives.
Got it.
So for people that are watching this, it's being transmitted through a data center. It's like the Amazon trade. I don't know if you're familiar with the Amazon trade. When you buy a package from Amazon off your cell phone, you use 3 different REIT sectors to get that package to your doorstep. The cell phone to press the send button, the data center to process the order, the industrial REIT to deliver it to your doorstep. We're constantly using REIT-owned properties every single day without thinking about what's going on with the Fed, what's going on with the 10-year Treasury, et cetera. So because tech is so important, especially data centers and cell towers, they make up 25% of the market indices that are out there because of market cap. But office REITs, which have been around for a long time, and there's 2 publicly traded data center REITs. There's like 12 or 13 office REITs that are out there. The office REITs only account for 4% of those indices. So how 2 or 3 names could dominate 25% of the market cap, shows you how tech has become so important. But in the same breath, go back to that data center example. Do you know how many Zoom calls are happening right at this moment in
thousands,
this country?
I'm sure.
Do you know how many people are streaming off of Netflix?
More than thousands.
In a given
YouTube.
night? Or YouTube, and there's some of the statistics on this is a dated number. You want to talk about a sidebar? This is a dated number. I was at a REIT conference. This is several years ago at this point now. But the former CEO of American Tower, his name is Jim Taslett, who's now the CEO at Lockheed Martin. Jim was speaking at this conference, and he dropped some ridiculous knowledge. But he's like, this again, several years ago, did you know that there was 24 hours of YouTube video posted every minute? 24 hours of content posted every single minute on YouTube.
Insane.
Again, how is that being processed? Through data centers. Cell phones, another great example. Think about what you can do on your cell phone today that you couldn't do 5 years ago or 10 years ago. You mean I can stream an entire movie on my cell phone and take up this amount of battery or whatever? And again, all through a data center streaming that video out to your cell phone. It's taken over the world, clearly. Now the next question is, okay, how does AI play into the world of REITs, and is AI going to be like one of those new sectors that's out there? And we're seeing AI obviously on the office side because of office leasing. You see it at apartments because AI is doing the conversation with the prospective tenants, little things like that. It is taking over the world more so, but AI isn't going to, how do I say this? AI isn't going to do the surgery on you. The robot may do the surgery, but you still have somebody overlooking the robot to make sure that they're doing what they're supposed to do.
You still need the hospital.
There's always going to be a human element involved with AI. And I'm somebody who uses AI every single day in some of the stuff that I do, and you still have to govern, wait, that's wrong. We can't put that in there. So I think technology is not going away on the REIT side, but it's evolving a lot of these other sectors that have caused their tenant base to adapt. The tenant makeup has changed because, again, of the AI tenants coming into place. That's just a whole new beast. Look, you're talking about an industry, again, 10 years ago, there was no such thing as cannabis REITs. There was no billboard REITs. Timber wasn't really considered a REIT sector. Cell towers and data centers took the longest time for the biggest REIT investors to embrace it, because it was, that's we can't get involved in infrastructure. That's not part of our
It's such a
in
niche.
the box
It is such
mandate.
a niche. Yeah.
And now it's like, oh my gosh, if you're not in that, what's wrong with you? So you've seen that investment philosophies shift.
Yeah, it's very interesting, and to be seen. And I think another thing that is interesting to me, I was just listening to a podcast recently that was talking about how much more challenging it's going to be for venture capital to get into the tech space, just because there's companies coming online that don't need to raise huge amounts of money for their seed A, B rounds. It's more in the latter half when they're starting to bring on more infrastructure, more employees, but AI can take a lot of that. So I think, there's an interesting thing to be thunk about, okay, well, they have to deploy that capital somewhere. And now you're here preaching just about how undervalued right now these potentially very profitable investment vehicles are. So let's get into REITs. Let's get into the fundamentals. Well, we can talk more about the other parts of financial markets offline. So you mentioned the Amazon pathway going from, I think I can't remember the first one. I need one more coffee. But the data center is the pinging from your phone, then going to the warehouse to actually get it delivered. It might even stop at a retail center before it does get to you if you're picking up somewhere. But I think, all in, most people don't really realize how much their lives interact with the world of REITs. So I'm curious, what do you think are the ones that most heavily interplay in people's day-to-day lives? And you talked about data centers a little bit. What are some other ones that are maybe under the radar right now that people should be maybe more interested in than they are?
I mean, go get a cup of coffee at Starbucks, go to the grocery store and get groceries at the shopping center, go work in the office building because you're back to the office. You go to the doctor's office because it's time for your annual checkup. More times than not, these are REIT-owned properties. I always say that it's very easy just to collect REIT dividend income by living your normal course of life. Wake up, go to Starbucks, go to the office, go to the movie theater at night, go out for dinner, go send a package in the mail, whatever. You're using all of these different REIT-owned properties. Again, with 20 sectors, especially on the digital side, again, with the cell phones and the data centers, where it's constantly, as far as we're involved with this. It's just going to be something that's going to continue to grow and grow. And it doesn't matter if you're in Los Angeles, Dallas, or Provo, Utah, or Missoula, Montana. You're using these properties every single day. Mm-hmm. We get bogged down in all the headlines that we see on TV or whatever is in the newspaper, we hear on a podcast, but most people don't, what I say, peel back the layers of the onion and get to the company issue. And I know we'll get into it, but like as an example, oh my gosh, I can't invest in REITs because of this commercial real estate wall of debt that's coming due. Or I'm not going to buy an office REIT because work from home is here to stay. We're never going back to the office building. Okay, let's peel back the layers of the onion. Let's look at the company level. Wow, you're 70% back to the office. You're reporting 70% of your tenants are back, and that's up from 60% last quarter. Huh, more people are going back to the office. Okay, that's interesting. Mm-hmm. I think it's really important because the world of REITs are just a little tiny blip of the world of commercial real estate, but they get lumped into everything. Mm-hmm. So when I talk about REITs as a whole, I always use the analogy that it's like you're graduating high school class. You had the top 10%, the valedictorians, the salutatorians, the kids that went to Harvard and Yale, the REITs that are in the S&P 500 and are dividend aristocrats that have raised their dividends for 25 years. Mm-hmm. You got the bottom 10%. The bullies, the troublemakers, the kids that were in detention, the kids that graduate with a D-, the REITs that are over-levered, that are cutting their dividend, that are, let's say, going concerns. But there's 180 students and companies that are in the middle of that curve that don't get the time or attention or any coverage. But it's that middle part of the curve that's adding the value in the portfolio, that's adding alpha, that's driving the dividend growth in your portfolio. It's all of these great companies. So it's very easy to focus on the one company that's not covering their dividend and then lump the entire sector in as one because, one doesn't represent the whole, but to the average investor who sees that headline has that gut reaction of, oh, this guy cut their dividend, sell all the REITs. And that's wrong. Because inside every single sectors that's out there, there's guys that are really kicking butt and taking some names. Mm-hmm. And there's maybe one or two that aren't. And is it because of the balance sheet? Is it because of the markets they're exposed in? Is it the sector that they're involved in? Every single company has a reason why they're up here or down here. And it's very easy to figure it out. But that's what we're doing at Hoya is we cover every single one of these companies. Yeah. We build the relationships. We try to understand what's going on because this goes back to the education thing. It's building that trust with your investors and readers and prospects that we're not just here to sell you something. We're here to educate you about something. And I tell folks, and I'm very blunt about this. My partner hates that I say it, but it's true. I don't care if you buy my ETFs or not. I really don't. What I care about is I want you to understand why we want you to buy REITs, whether it's owning the stocks, owning the ETFs, whatever. Here's why you need to own this sector. REITs are boring. Boring is good, especially in times of volatility. Yeah. In choppy waters, you want to own boring stuff. I've heard the REITs are the tortoise and the hare of your portfolio. It's the ballast of your ship that keeps your ship afloat. Mm-hmm. It allows you to play the riskier stuff that's out there on Wall Street. Whatever your reasoning is, whether it's 1%, 5%, 10% or more, there should be a slice of your portfolio allocated to the world of publicly traded REITs.
100%. Yeah, I was actually thinking of tortoise and the hare before you mentioned it. And yeah, it's interesting because I think many people would be very interested in these kinds of investment opportunities if they knew about it in the first place. Mm-hmm. And that's what your work is. And that's why it's so important to get the word out there about these opportunities because they don't have the flashiness of a really high performing, Facebook, Apple, nor
NVIDIA, Microsoft.
NVIDIA, yeah.
And so I love playing this question. Everybody talks about the Mag 7, Okay. How do you observe NVIDIA in real time? How
Mm-hmm.
can you track NVIDIA or Microsoft in real time? You can't. It's literally impossible. You have to take management's word for it when they discuss quarterly earnings once a quarter. And Jensen Huang at NVIDIA gets on the phone for 30 minutes and tells his story.
Mm-hmm.
That's all you know. At least with REITs, you can drive by these shopping centers, these office buildings, these apartment properties, whatever the sector is. And as the first step in the investment research process, it's like eating.
Mm-hmm.
When you sit down to eat, what's the first thing that you eat with? Your eyes. Your eyes look at the food and be like, oh, wow, that looks good. I can't wait to actually taste it. It's the same thing like driving by that shopping center. So
Don't eat the building, by the way.
So
Sorry.
we were in Playa del Vista recently at a shopping center where there's a Ralph's grocery anchored shopping center very close to where we're sitting here right now,
Mhm.
if you know where I'm talking
Mhm.
about. And there's a great Starbucks that's over there. It was hopping at 9:00 on a Friday morning. And I said to the person I was with, where's the sign? Who owns this property? I'm really curious. Is this owned by a REIT? Because what else does this REIT potentially own besides this shopping center? So if I'm using my eyes as the first piece of investment, and I look at the center and I see new coat of paint, new sign, full parking lot, no vacancies, wow, this center is doing good.
Mhm.
But what if that's owned by a REIT and that's only considered an average property in the portfolio? Average.
Yeah.
Wow. Okay. Now I really want to see what else these guys own. And then that's what starts that snowball down the mountain where it's like, oh my gosh, I know that property. Wait, and they also own this? Oh, and they're also in this market? My brother's in this market. I should call my brother and ask him, hey, do you know this property? What is it like? And then hopefully it gets you to go to the website, read the press releases, learn about the company, learn about the portfolio. And then it's like, okay, that's what leads to that investment decision.
Mhm.
So you take what you're presented with, use as a starting point to then start going into the nuances of, okay, how are the earnings? What's the dividend look like? Is there debt coming due? And not every investor is going to do all of this, but at least looking at the property is the first step of, oh, wow, there's a broken light on that sign. There's liquidation banners in these windows, and they're calling this a good center. Yeah, I don't know about that. So I
Yeah.
think it's so important to really observe the property in real time. Sure, it's one thing to go around Christmas time, but looking at
Sure.
it at 2:00 on a Tuesday afternoon, when kids are back to school, whatever. Okay, and this center's hopping. Why? Oh, it's a grocery anchor. Everybody's going to that Ralph's. Okay. So what does that mean? There's demand for all the other stuff because people are going to go to the grocery store every week and get groceries.
Mm-hmm. Mm-hmm. Yeah, it's almost very empowering to be able to kind of make that discovery just based on your own observation and then not really have to go too far. I mean, you do have to do your due diligence and educate yourself about it, but you can go, "Ow, I saw how well this was doing in reality, in physical space, and I'm going to go put my money where I see good things happening."
Right, because of course every management team wants you to buy their stock. You're not going to have the CEO of Public Storage get on the line and say, buy Public Storage.
Mhm.
It's shopping center. Did you know that we've raised our rent double digits over the last 14 quarters? No.
Yeah.
Well, we have.
Yeah.
Oh, okay. So what does that mean? Is it going to continue for another 14 quarters? Well, we sure hope so. But, that which was out of favor not too long ago is now suddenly in favor. Another good example is senior housing. When you look at senior housing during COVID, it was like you don't mention the word senior housing because of what was happening. Now it's literally the hottest sector on Wall Street in the world of REITs. So why? I hate to be the bearer of bad news, but we're 40 minutes older than we were when we started this conversation. We're all getting older.
Don't remind me.
The
No.
but the amount of senior housing product that exists today is not enough for what's coming tomorrow. Another example is residential, apartments, single family rentals. There isn't affordable housing. Forget LA. We're not going to talk about LA, but middle America, the affordable house that costs $200,000, $300,000 doesn't exist now. So who's the beneficiary of that? The apartments, the rental players, but again, if we deliver more units, if the Fed cuts interest rates, if the 30-year mortgage goes back below 5%, if, then the stars will hopefully align to see this wave of new reinvestment coming back in.
Absolutely. So you said the magic word there, rent, which is the end-all be-all of any valuation, any investment decisions one way or another in the world of real estate and REITs in particular. So can you explain, we obviously have a lot of commercial real estate professionals who listen to this podcast, and they know in their bones how important rent is and getting accurate understandings of not only like what the rent is, but what are the lease terms, what are the agreements made between landlord and tenant, just what is the playing field within a certain property, and then trend-wise on a REIT scale in a collection of properties, what are the trends that are happening between landlords and tenants? Can you explain why and how much rents play a key role for those who maybe aren't as much in the commercial real estate space? Why do rents matter so much? And if you have any examples of how rent changes or even lease agreement changes can impact what's happening at the REIT level.
Sure. First of all, it all starts with rent. That is the source of the revenue stream, is rent. There is no dividend without rent. So in the world of REITs, it's all about the rent. Some sectors command higher rent premiums than others. Some sectors' results are more tied to rent than others. But there is no forward progress in any sector of the world of REITs without that rental income. So we'll start there. When you look at it on a sector by sector basis, use hotels as an example. Hotel, you're paying one night of rent. Your rent number is a spot figure. And that number could vary whether I'm looking at Trivago, Hotels.com, or Marriott.com. I will get 3 different numbers of what that rent is. Okay? Branch out. Resi, apartments. That's usually a 1-year rent. I don't know when the last time was that you went and got an apartment that you sat down with the apartment landlord or the person in the office who's like, hey, Shanti, I got great news for you. Your rent next year is actually going down. We're going to lower your rent next year. Instead of you paying us $2,000 a month, we're only going to charge you $1,800 a month.
Would love to hear that, personally.
You and every other renter that's out there, because you know why? It's not happening. Then expand further. Office, 5 to 10 year lease. Net lease, 5 to 10 year lease, probably. But then you could start going to like ground leases. So a company like Safehold that's got 99-year ground leases. So you're talking about a rent stream, a rental income stream from either 1 day to 99 years. That's a pretty wide
big
spread there.
Yeah.
So I like to focus on the, we mentioned the shopping center, the 14 quarters of double-digit rent growth. Okay. But look at the apartments. Apartments were, frankly, kicking butt and taking names during COVID. They were like minting money, double-digit NOI growth, like just to the moon. And now they're not. And now they're getting beat up because they're not. It's almost like unrealistic expectations. And when people are like, oh, well, David, MAA only reported 2% NOI growth. Like, why would I buy this? And I'm like, okay, so let's break that down. They still grew 2%. They're still putting up a plus, right? But also, how about that sequential number, quarter to quarter, right? So our NOI was up 1.8% year over year, but we were also up 1.5% on a sequential basis from third quarter to second quarter. Well, that's a pretty good sign that rents are continuing to go up. If you pushed it up 1.5% over the previous quarter, we're moving in the right direction. A good management team is able to kind of look down the road and see where that rental stream is going, because indirectly the dividend policy is based off of that income stream. And then I get the question of, well, David, these companies are leaving money on the table because they're 97% occupied, and how do they really grow rent? And I say, okay, 97% occupied in an apartment property. That means out of every 100 units, you've got 3 open units. How much can you actually grow rent in the big picture when you've only got a couple of open units every single month? Yeah, you're getting market rental rates, whatever it is at that point. But the cool thing about real estate and what we do, I know what the rent is at that property. The landlord knows what the rent is at the property across the street, what Blackstone is building down the block. Everybody knows what the rent is in the general area. So how much are you really going to fight each other when it's not that it's price fixing or anything like that, but because of some of the technology platforms that are out there, the CoStars, the Real Pages of the world that'll tell you, here's what the rent is at that property. We can kind of gauge of, okay, 97%, 3 open units, market rents going up 1.5%. That means that we're going to be able to push this X, which means hopefully at the perfect end of the picture that we could push that much income down to the bottom line. But think about it on a guy like Invitation Homes that owns almost 100,000 single-family rentals across the country. The rent that they're going to charge for Dallas may grow differently than what the rent is going to charge in Wichita, Kansas. But the goal, by and large, is that the rent number is to continue to go up, which translates to higher revenues, which translates to higher net income, which translates, hopefully, at the end of the day, to a higher dividend. So without rent, there is no real REIT industry that's out there.
Yeah, absolutely. And because of the compliance and the fiduciary duty to those investors, you do have to be very judicious with what properties you decide to invest in from the perspective of a REIT, right?
Well, it especially helps if you're singularly focused. It used to be where REITs were very diversified. We're in shopping centers, we're in resi, we're in X, and we're in Y. And over time, the market, frankly, has punished those companies that have really gotten very diversified, and they'd rather be very singular focused. You're an apartment REIT, you run apartments, you're in these markets, stay in those markets and do what you do best. And you branch out, you're going to be penalized for it.
You see a similar thing occurring actually on the broker side. We've seen a lot of, you have the big JLLs, the CBREs, but I've seen increasingly more and more brokers not only are spinning out to their own shops, but they're hyper-focusing. Like Bob Knackle's a great example. Shout him out all the time. Sorry, Bob. But he only does New York, and he only does investment sales, and he's really, really, really good at that one market and that one facet of real estate. And he's not going to do anything else.
All right, so you brought up Bob.
We invoked
Bob,
him.
great to see you. Thanks for Bob's a friend of ours. He is a perfect example about education and knowledge. Because you can go up to Bob and say, Bob, tell me about this property right here. Number one, he was probably involved in a transaction on that property, literally. But he'll tell you every single number going back 40, 50 years on that property. That's knowledge. That is not something that you can just say, okay, new employee, you're going to sit down and write down all the stuff that's going to come out of my head, and this is going to be like my gift to the industry. That's captured up here. And only a guy like Bob is able to share that wisdom with others. It wouldn't mean the same if it's coming from the 45-year-old person that's not Bob, if that makes sense. That lifetime of experience of being in the trenches, of knowing the parties, of the brokers, the players, that city backwards, forwards, inside and out. There isn't really an expert out there that can frankly compete with him on that.
In his market, absolutely. I think what I'm really interested in is, and this is where we get more into the tech side of it all, right? There's so much more. And you hit an interesting point, I will say. It takes a person like Bob who not only knows the stories of the transaction, but knows the numbers, knows the history, and can pull that where it's relevant and most important and will be of most valuable to the people he's talking to. But there are now a lot more places where somebody who is totally committed to learning their market and the nuts and bolts of their niche, like, again, I'll invoke another celebrity strip mall guy. He knows strip malls. He knows them very, very well. It's all he does. Value add strip centers is what he does.
No Chick-fil-A.
No Chick-fil-A, though he has had some Chipotles on his property, I've noticed. But that being said, it's the same thing. It's trending towards, I'm going to focus on this thing that I have a very strong core thesis about and learn everything about it. And more brokers, especially powered by tech, by a broader accessibility to data, more seamless and faster communication between parties with things like social media. You know, they can watch your segment on Bloomberg and then go find a comps list of this particular property. And there's just all these different pieces they can go after to synthesize and build that expertise. So I'm very curious to see how that pans out. I will say that's also a lot for the average person who may be looking to invest in REITs, but doesn't have time to do all that stuff,
Yeah,
right?
we can unpack that. First of all, I was always taught do one thing and do it well. And Strip Mall Guy and Bob are two great examples of guys that do one thing and do it well.
Mm-hmm.
So shout out to them. When it comes to REITs, as far as data, there's a lot of data that's out there.
Yeah.
And the data that covers self-storage is completely different than the data that covers the apartments, right? You're talking apples and oranges, night and day. They don't operate. But when you look inside, again, peeling back the layers of the onion, there's great companies that do the data for those sectors. So an example would be like Yardi Matrix. When you think about self-storage, when I'm looking at those numbers, it's usually Yardi Matrix data that kind of leads that conversation. Sure, you've got the CBREs and JLs that are doing the storage reports, but people kind of trend towards Yardi for the self-storage stuff. In the world of lodging, it's Smith Travel Research or CoStar STR these days. It used to be Smith Travel Research back in the day. But STR data is vital to the day-to-day, week-to-week operations. How about TSA numbers at the airports, which gives you a good gauge of where people are going? I always like to use the Las Vegas gaming numbers, what the state of Nevada publishes monthly, because it kind of tells you how many people are coming to Vegas. And we've seen a lot of stories recently about some weakness in Vegas. But shout out to Ed Petoniak at Vici Properties, where Ed, who basically owns the Las Vegas Strip, he's the landlord to the Las Vegas Strip. Ed will tell you, David, the news article says this. Here's reality. Here's the real figures. Here's the numbers that you should be looking at. Yeah. So the stuff that we look at might be different than the executives at the company level, but there's enough data that is published very regularly, especially if you're in the world of apartments, between, again, RealPage and Zillow and CoStar and some of these other sources that are out there that kind of tells you where the puck is going. That's important. And that's the job of all of these REIT management teams, frankly, is where is that puck going? Where's that ball going? What is the next Raleigh, Austin, Tampa, Nashville 5 years from today? Is it Wichita? Is it Oklahoma City? Is it Milwaukee? I don't know the answer. Again, it goes back, if I knew that, I'd be on my way to Fiji right now. But that's the goal of a good management team, is to figure out, how did this shift happen to where we are? What data prove to us that this is where people are moving to, that we're going to plant our flag here, and this is going to be where we're going to be for the next 10, 25 years, because the data is pointing us to where it's going to be.
Yeah, absolutely. And, you know, oh my gosh, hang on, let me pause because I had a good point. Now I can't remember what it was. I'll let you get some water. Yeah, I guess to kind of give a nice underline to that, what would you say? And we talked a little bit about, you know, if you can see with your own eyes how active the Starbucks and the Ralph's is at the shopping center on a Tuesday morning, then that's a pretty good clue of, you know, this is important data to look at. But if you had to give the average investor that's interested in REITs doesn't know where to begin, what data points would you recommend to them to kind of use as a good starting point, at least, to get more informed?
The public traded REITs are notoriously famous for the transparency that they provide to the investment community. Press releases, earnings press releases, investor presentations, supplements, webinars, white papers, the list goes on and on. The REIT industry is so good at putting out content to educate advisors and investors about the whys of REITs. Inside each of those sectors, as I mentioned, there's a lot of data that a lot of the guys point towards. And so it's very difficult to say to the average investor, oh, just go here. This is where you're going to learn it all. I think when it comes to that type of content, I'm not trying to sell myself here again, but this is kind of, again, what I do every day, because it's looking at all of those commercial real estate publications that are out there, all of those commercial real estate websites that are out there, the Globe Streets of the world, the Commercial Observers, you know who the various media sources that are out there. They're the ones that are putting out those data points to educate the advisors. But the average investor doesn't know that Globe Street exists from like a news perspective. Or CoStar, some of these guys are behind the paywall and you can't necessarily get access to the information. The end investor really just cares about one thing. What's the stock price? What's my dividend? Is this a going concern? You know, it's the more sophisticated guy that really wants to get into it. And you can really go down the rabbit hole because, look, you can go take down Green Street Research, pay a lot of money for some of the best research that's out there. And they do have retail customers that take down their research. You could go work with a sell-side brokerage firm. You know, for those that are watching this, that have accounts at, you know, a Wells Fargo, a UBS, a Morgan Stanley, wherever. All of those firms have REIT analysts that publish REIT research very regularly. So it's not hard to find the information. But again, it goes back to what I was talking about earlier about 25 guys that cover public storage. So this is the problem. This is why due diligence is so important for every single investor. We'll use the Amazon example, 60 buy ratings. Does Amazon truly warrant 60 buy ratings? Well, do you want to be the guy that puts a sell on it? Because if you put a sell on it, you're never going to get any business from Amazon corporate. Okay, take it a step further. Sure, 25 companies. There's 12 buys and there's 13 buys and 12 holds. Great. Price target. Stock's trading at $20 a share. The price targets range from $15 to $25. What do you learn at the end of the day, you know, as again, the investor, when you're basically stuck in the middle? Am I supposed to buy this when the price is right in the middle of this price ranges where everybody's got a buy or a hold? Does that really mean it's a buy or a hold? Again, I don't know, because what makes NVIDIA a buy to me makes it a sell to you. I don't think there is a set answer in the playbook, you know, that solves that question. But I look at it again like practical use. The number of Zoom videos that are happening every minute, the amount of content that's posted on YouTube, but some of these sign points that we can look at like, oh, wow, that continues to grow. That's not slowing down anytime soon. Maybe I should be putting money here. Look at the world of ETFs. You know, back then there was only a couple of ETFs. It used to be dominated by SPYs and triple Qs. And now you've got 4,000 ETF products on the market. Some that are beyond complicated and risky that, you know, not for this audience. And some stuff where it's like, oh my gosh, how boring is that? Versus, oh my gosh, what does that even mean? I don't understand. Like, there's an ETF out there for everything. And yes, we have 2 ETF products. It's a little bit different, and I know we'll get into it. But I think it's really important, no matter what the investment is, buying Apple, buying Microsoft, buying public storage, you got to lift up the hood of the car. You got to analyze the properties themselves. You got to, you know, I'm not saying go look at every single property, but trust the company, because they're telling you, again, the REITs, here's our portfolio. Here's what we did last month. Here's a property by property breakdown. You really could zone in on the property level and kind of gauge how things are going.
Those are long reports, I'm sure.
Oh, yeah.
So let's just get into the ETFs that Hoya Capital is looking at and puts together. Can you explain a little bit more about, what is yours and your team's investment strategy when you're analyzing whether or not you want to add a REIT into this fund, or just I'd love to know more about like how your thinking works when you're looking at all these different options. Obviously, you've walked us through a lot of your logical reasoning for certain sectors. But yeah, just a little bit more picture into how your team holistically thinks about where to pay most attention in assets.
So we cover REITs and real estate from two different angles. We have a residential or a housing ETF. The Hoya Housing 100 ETF covers home builders, home goods, supplies and furnishings, the brokers. It's a holistic way to cover the entire housing industry. That's a little bit different than our high dividend yield ETF, REIT, which covers the REIT industry as a whole. We're looking at all of the REIT industries. So to answer your questions, it's a layered answer. First of all, we start at the company level. As I mentioned, we're education first. So we're covering every single one of these companies. We write research on them daily, weekly, monthly, quarterly, annual research across the entire sector. Might get in trouble for saying this. Sorry, Alex. I think we publish more content as an ETF issuer than any of the other firms that are out there on Wall Street. I think we literally publish more content than any other firm when it comes to ETF.
Did that come from you, or
started by partner Hoya? So Hoya Capital started in 2015. It's the largest seeking alpha REIT research platform that has morphed into an investment management platform running two ETFs, SMAs, separately managed accounts. But we have a very wide audience, very retail heavy, but we have paying subscribers, followers, guys that kind of, I don't want to say hang on every word, but come to us for our REIT research and content. My daily note, my partner's daily note, our weekly publication, our quarterly earnings recaps, our quarterly sector write-ups, our state of the industry. Like, we literally cover it high to low. So to take it further, we run a rules-driven process. A lot of firms, ETFs, are either passive or active. Though ours are technically marked as passive because we only rebalance them twice a year, I always say we are actively passive because, again, we are covering these companies. We're interviewing management teams. We're always putting out content with these companies because it's one thing for me to tell you to go out and buy Public Storage. But have the CEO of Public Storage talk to you for 20 minutes on the phone or on a webinar, he's going to have a whole new world of investors that's going up. So I am just a mouthpiece or a pedestal to the entire industry. So we have a rules-driven process. We start at the sector level, the property level. We analyze all of those. We start looking at management. What's management's track record? Do they put up? Do they shut up? Are they just cashing a check, or do they really believe in what they're trying to do? We cap our sector weightings. We cap our geographic weightings. The goal of both funds is to provide a truly diversified portfolio that, should there be day-to-day volatility, that the diversification will weather that volatility. Case in point, a dividend cut. Let's say one of the REITs in our high dividend yield ETF cuts their dividend, and we did see that earlier this week. Well, the max weighting is 1% of our names. So that means that you're still protected on 99% of the portfolio that, again, in a perfect world, compliance, blah, 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 you would hope that the REITs that raise dividends would offset the decrease from that one company, if that makes sense.
Sure.
Because by and large, the end investor, I say this in all my interviews, and I really boil it down. The end investor, grandma and grandpa who live down the villages in Florida, who are enjoying retirement on the golf course today, want their investment in Apple, Microsoft, NVIDIA, Public Storage to do four things at the end of the day. Here's what you want the company to do. I want that company to grow their revenues. I want them to grow their profits. I want them to grow their dividend. And I want them to grow their annual guidance. We're going to put up $4 to $4.25 next year. We're going to do $4.25 to $4.50 the following year. How much they're going to put up in earnings every year. If the company is able to do those four things regularly, ignoring interest rates, treasuries, inflation,
Mhm.
tariffs, all the stuff that CNBC, Bloomberg, Fox Business, and all the business channels are telling you to focus on. And the company could put the blinders on and focus on the fundamentals.
Yeah.
You would say the company's on pretty solid footing.
Hmm.
And that's pretty much what's happening across that bell curve that we talked about, the 10, 80, 10, where even that bottom 10, some of those guys are still doing some of those things very well, but are in the penalty box for different reasons.
Hmm.
So here at Hoya, we cover the good, the bad, the ugly in a very fair and balanced perspective.
In fairness, let's say the great, the good, the ugly. Because you like that middle section.
Yes. No, I'm not calling the middle section bad. I'm saying, no. Pardon me.
I'm teasing you.
We'll edit that. There's so many great companies that don't get the time or attention. As an example, pre-last election, one of my favorite REITs, and I'm very transparent about this, and management likes me, is a company called Easterly Government Properties. The ticker is DEA. Mm-hmm. And you may have not known about DEA until after the election because DOGE went in and cut all the government office leases. Mm-hmm. DEA was the government landlord. They were the landlord to the FBI, the TSA, the Department of Veterans Affairs. They were literally the government landlord. And I don't think we're closing any FBI field offices anytime soon. I don't think we're getting rid of the TSA anytime soon. Like, this is a very steady revenue stream. So why Easterly? Okay. If you go out and buy a government treasury, like a T-bill from the government, who pays you the interest on that T-bill? The government. Mm-hmm. If Easterly is renting space out to the government agencies and the government's the one writing the check for the rent, wouldn't that mean the government's paying Easterly's dividend, mostly, that they're paying Easterly's dividend to the shareholders? That's about as safe and protected as it gets.
Yeah.
Another example is a company called Postal Realty Trust, PSTL. Postal is basically the publicly traded REIT of the post office. Yeah. Did you know that most post offices are privately owned?
I did not know that.
I didn't know that either up until several years ago when Postal Realty went public.
And they're rented.
I'm sorry?
They're rented by the Postal Service.
Correct. And by the way, if you went and talked to the Postal Service, they would tell you that they are not, they're an industrial REIT. The post office would tell you that they're or the postal would say that they're industrial REIT because, again, think about the airport, the mail facility at the airport where process everything. So, here's the misconception, here's the reality. And I think that's what a lot of folks mess up about when it comes to the world of REITs, that they get too buried in the misconception of what's being promoted to them without really looking at what's going on at the company level at reality. So again, that's why we're very hands-on in our approach, and we try to generate, frankly, the most diversified portfolio that is going to kick out, frankly, the highest yield that we can. And right now, our high dividend yield ETFs annualized around 11%. We pay monthly dividends. Mm-hmm. We're the only ETF on the market that has both common and preferred stocks. So we have an allocation to preferreds, which add an extra couple of percent of yield to the bottom line. Mm-hmm. And why, we haven't really talked about dividends and why dividends matter.
Let's talk about it.
Great. When you think about REITs, they're dividend income machines from a very high level. Stocks trading at $20 a share. Company pays a $2 a year dividend. In 10 years, you've recouped the principal of the stock price. Okay. As an ETF issuer, as somebody who owns a bunch of stocks in their funds and everything, here's what I can tell you. I have absolutely zero control over my stock price. I can't do anything about my stock price. More importantly, my constituents, the 100 companies in REIT or homes, they can't do anything about their stock price. But they can control their dividend. And I think that's what matters. When you think about buying a stock, your total return is two components: stock price appreciation, dividend component. When it comes to the world of REITs, it should be the other way. It's dividend income plus any stock price appreciation. So I always like to say, you focus on the dividends, and any upside that you get in the stock is like the cherry on top of the sundae. That's the bonus that you get. Because when people get caught up in the headlines, again, remember talking about the hotel, the one night versus the apartment at 1 year, or the office at 5, 10 lease term, et cetera. How much is that company going to pay you in dividends over the course of 5 to 10 years when they already know what the rental stream is going to be, because That office tenant signed on at the Empire State Building at a rent increase tied to CPI or SOFR or whatever it is. They can already forecast what that rental stream is going to look like. So what I'm telling you is that company is already thinking about what the dividend policy is going to look like next year, the year after. And in a perfect world, the dividend policy looks like this. You want to see slow and steady increase. So as I tell folks, the greatest gift that you can give to your child or your grandchild on the day your child or grandchild's born, go out and buy them a share of like realty income. And a DRIP. Do you know what a DRIP is? A dividend reinvestment plan. So as realty income pays you those monthly dividends, you're reinvesting it back into the stock.
Yeah.
And now that one-day-old child that owns one share of realty income or IBM or Disney or some of these other stocks that allow you to drip the dividends, by the time that child turns 18 or 25 when they can cash in that account, they've already got 50 shares that all it cost was that original to buy that one share. Here's another great example. My partner, as we were talking about this, he's like, did you know that you could buy a share of the Empire State Building, a share of that 100,000 rental homes that owns by Invitation Homes, and you could buy a share of Digital Realty, which owns 300 data centers across the globe. 3 shares you could buy for less than $200 total, all in. And that $200 gives you a fractional piece of the Empire State Building, 100,000 rental properties across the country, and the data centers that are running all the Zoom conversations, Amazon packages, and Netflix streaming, and everything else that we use the cloud for. That's pretty interesting. And you have the same economics as Berkshire Hathaway or the largest institutional investors that are out there. Our sector is so approachable for the average investor. For the average person that's just looking to earn dividend income, this is the sector to be in. One more point. Dividends. If you market cap weight, the biggest to the smallest, market cap weight the dividends, the yield is around 4%, give or take. At this moment, the 10-year Treasury is at 4.30. The Fed funds rate's 5 and higher, whatever it is. So technically, at this exact moment, on a market cap weighted basis, fixed income is more attractive than REIT dividend yields. If you equal cap weight it, so the biggest company is the same weighting as the smallest company, that yield goes to north of 6%. Okay? So again, that's why it said that middle part of the curve is where there's real value to be had in our sector. If the Fed cuts rates, the 10-year Treasury yield declines, the Fed fund rate declines, but REITs continue to raise the dividend because we're still going up pre-COVID, then the gap between REIT dividends and fixed income continues to widen, which makes REITs that more attractive. So as, again, the sentiment turns, balance sheets improve, valuations improve, now you've got some animal spirits that are picking up in our sector to see M&A activity, aggressive accretive acquisition opportunities. And there's some good companies that are out there when you look at the NAV discount versus premiums and how much they're able to do. One final point, dividends. Who knows a thing or two about dividends? Berkshire Hathaway, right? And the only reason I mentioned that, they just released their most recent holdings list. They disclosed a stake in Lamar Advertising, a billboard REIT. Nobody talked about it. Everybody was focusing on them making the bet on the home builders. By the way, great for us. We're happy about that in the homes ETF. Thank you. But in all seriousness, nobody focused on the Lamar Advertising print. And we found that to be very interesting because, again, Warren and Berkshire know the world of real estate. They own real estate platforms. They own REITs. They've owned Store Capital in the past, which is a net lease REIT that's no longer publicly traded. They acquired a stake in it. I tell the story as much as I can. There's a very famous story of Warren Buffett in the REIT industry going back into the 90s where Warren auctioned off his wallet. You could buy Warren Buffett's wallet.
Amazing.
And inside the wallet was a tiny piece of paper. And inside there, that paper, folded up, was a stock ticker. And it was First Industrial. It was an industrial REIT. That's what he recommended when he auctioned off his wallet.
Wow.
So anytime I see Warren do anything in the world of REITs, it always gets me excited.
Yeah, you're watching.
And trust me, they're not going to buy my ETF because they're single stock pickers, but it just proves to you that everybody's on the hunt for income. And think about the Buffett approach. It's got to be on a moat and an island by himself. It's not easy to compete against. All these things that they focus on. And billboard REITs are the perfect example of that because of zoning, because of cost of development, looking at the digital transition that we're seeing going towards digital, away from, I guess, banner old school outdoor.
Yeah.
That digital means higher revenues, higher dividends, again, indirectly going out to the shore. By the way, only 2 publicly traded billboard REITs that are out there, Lamar Advertising and Outfront Media. But they're not really thought of as REITs, just like Timber, Weyerhaeuser, Rayonier. They're REITs, but they don't get really thought of as REITs. And so that's why it's like, yeah, you're right. But you know what? We're not building more land. We're not really building more trees. So
hopefully we will.
But you catch my drift
yes,
here.
Exactly.
That that's a commodity.
Yep.
And so, like, how does New York grow? They go up. How much up can they go? A lot. There's still a lot of way for them to go up. Air rights. I wouldn't be shocked if we see an air rights REIT come down the pipe in the next 20 years.
There isn't one?
No.
Oh, interesting.
So that's what I'm saying. Like, this is just, again, a sector that's going to continue to evolve more and more.
Yeah. And it's just miles ahead more accessible to the average investor than having to have a crazy checkbook that can buy. You don't need to buy a property.
You don't need to have $1 million in the bank to go out and buy REITs. You've got private deals, GPLP type stuff. You can go out and buy shares of B REITs or all of this other stuff. Again, I'm not trying to sell us, but like our high dividend yield ETFs trading around $10 a share. So for $10, you could own 100 companies that own tens of thousands of properties across the country. You can buy, there's some REITs that are trading literally for pennies, 50, 60 cents on the exchange. So you can, and then I think there's Equinix, which is trading at like $800 a share. So a couple of pennies, $800, 1 night lease term, 99-year lease term. Like there's something out there for everybody. That's the cool thing, like social and everything. There's a story out there for everybody. There's, what interests you. I guarantee you can't use the word guarantee. I guarantee you there's an ETF or a stock that's out there that would be like, oh my gosh, it's exactly what I'm looking for.
Guarantee your interest.
Yeah, I guarantee that. That's what I'm looking for.
Not financial interest, just your heart interest.
Yeah, I can't guarantee it's going to go up or down. I mean, again, we all wish everything would go up, but that's, again, when you buy REITs though, when I tell folks about the dividend compound machine, I tell people, you don't buy a REIT for the day-to-day movement. You're buying the REIT for the income stream that's going to pay you over the next 25 to 50 years, where you could then hand to your child, your grandchild, here is 7 figures worth of wealth from you that I've built up over time because I own these REITs. Keep this going. This is the nest egg for the next generation of our family that we're raising here. And it's because of this basket of names that's just going to keep pumping up dividends and growing and growing and growing.
To what extent, and I want to be mindful of time because we can keep going, but we're stretching the time limit now. But I'm curious, of the full, let's say, just the United States financial markets, what amount of capital do you see flowing into the REIT sector currently? And, as more knowledge about these funds become available, do you think you will start to see more of a shift in its popularity as a vehicle? Or where is the forecast of REITs as an investment machine for the broader world of investors?
Sure. If everybody uses this, REITs are interest rate sensitive and interest rates are going down, then it's going to bring in a whole new wave of investment dollars into the sector.
Where does it stand now? If you were to
I don't know the exact numbers of what the number of inflows are. I mean, I can look at our fund and I see that we are getting inflows into our REIT fund, whereas some of the other REIT managers are dealing with some volatility because unfortunately for Wall Street, the model is shifting that mutual funds are transitioning to ETFs. And so a lot of the mutual fund issuers have been losing money to ETFs, or they're putting on like riders that allow them to amend the share class so they can launch an ETF share class.
Oh, interesting.
The universe today, when you look at the investment pool, is different today than it was because you look at, a 25-year-old young adult, they're not looking at REITs as an investment vehicle. they're looking at crypto and, again, NVIDIA and all.
Mm-hmm.
And so it's my job to try to emphasize why diversification is important,
Mm-hmm.
why you should go out and buy, let's say, Equinix.
Mm-hmm.
Okay, you want to play the riskier side of it. Well, here's the data center side that's running all this infrastructure. REITs are the backbone to the infrastructure of our daily lives. This is an easy way for you to play it. Own this so that you can go out and play the single stock future ETF risk product that's out there.
Yeah.
But I do see that, unfortunately, it's all market driven, that as fundamentals continue to improve and sentiment continues to improve will lead to that next rush into the industry. I always get asked, what's the next sector? What's the next cannabis? What's the next timber? And I mean, I don't know. Is it going to be solar? Is it going to be AI? Is it going to be something in the metaverse? Who knows what the answer is?
That's a whole other conversation.
Sure. Who knows what that answer is? But you know what's not going away? The need for our house, our roof over our head to go to sleep every night.
Mm-hmm.
The need to go to the grocery store and get groceries every single week. That those bread and butter REIT sectors are always going to continue humming along. But there's sectors that continue to do well. There's sectors that are kind of struggling. But when you look at the big picture, we're still using these properties every single day.
Yeah. Things you can touch, see, interact with. Always prove to be old reliable.
Right.
David, this has been a lot of fun. I could keep going for a while, but I do want to give some time to a couple rapid fire questions before we let you go. What is the best advice you've ever been given about being successful in REITs?
I have to think. I've spent a lot of time thinking about this question, and I still haven't been able to. I have a lot of different thoughts that are going through my head when I get asked that, because I've heard over the course of my career different philosophies, different thoughts. And I think, I guess I've already kind of said it. My father was a CPA. Every single day, he would go to the office and do the same thing over and over, tax returns and all that stuff. And it's the same process, the same procedure. The only thing that changed was the numbers, right? Why I got on Wall Street was because it was the anti-CPA route. Meaning, I don't know what to expect every single day when I sit down at the desk. I don't know what to expect every single hour, let alone every single minute in a social media economy that we operate in today. And to know that the market can literally intraday go like this because of a tweet, a press release, a Federal Reserve meeting, whatever it is, this volatility is going to lead the average investor basically to the toilet to go throw up. And so I guess one of the things I was always taught was focus on what's in your control. That which is out of your control, don't stress out. Put the blinders on, focus on the fundamentals. Understand that there's always three sides to every story. You've heard that expression, there's three sides to every story. And you've always got to focus on that third story, the truth. And I think with REITs, they do such a good job of trying to put the truth out there, as well as very smart analysts that help the general investment community digest the truth, that it's on the end investor to grasp what they're being given to make sense of it all. So focus on the big picture, ignore the day-to-day noise, focus on the fundamentals. Good things come to those who wait. Those are the types of things I've been taught, for a long time. But when it comes to REITs, I think it comes back to that invest with your eyes. That use that as a starting point before anything else that you can do. And trust the education process. Do you want to be a salesperson or do you want to be an educator? As soon as you put on your sales cap, buy my ETF, everybody buy my ETF, I'm going to lose half the audience. They've already tuned out. But if I come across with this education approach and why you should be buying this sector, because Fed interest rate cuts are on the horizon, property fundamentals remain solid across multiple sectors, dividend growth policy continues to grow year after year after year, focus on the big picture. And more importantly, ask yourself, why am I making this investment? Why am I invested in this sector versus that sector versus this other sector? And have conviction in your beliefs.
Yeah.
Be passionate.
Invest with your eyes. What's the worst advice you've ever been given?
This market will be done in 5 years. This REIT industry will be over in 5 years.
That's it. We come full circle to that.
No. I mean, that was definitely some horrible advice. I even sometimes bad advice is good advice. Where you can look back and, what may have seemed like was good advice at the time was not, or was may have bad advice at the time actually wound up being good advice. So I think it's really kind of important to, because this situation could change completely tomorrow. Like, again, I hate to use the 9/11 example, but the world of REITs was completely different the day before 9/11 and after 9/11.
Yes.
Pre-COVID, post-COVID, pre-housing crisis of 08, 09, and that's, okay, one other thing about the great industry about the REITs. These management teams have been in place a long time. They have deep benches. They promote from within. They grow up. And the cool thing is they learn from previous cycles. What did we screw up during COVID that we shouldn't make that same mistake the next COVID happens? What worked so well for us that we've implemented that we're still using today that we can build off the next time? So they learn from previous mistakes. Case in point is leverage. A lot of companies used to be 50, 60, 70% levered. Green Street put out a note in 2005, 2006 saying to the industry, get your leverage below 50%. And the industry, literally, all the companies were calling Green Street, that's not happening. That's impossible. We're not going to do that. You're crazy. You don't know what you're talking about. Fast forward, all of these companies are sub 50% levered. So they learn from previous cycles and previous lessons on how to best conquer the future. That I think that's why, again, you can just get, stay in your lane, collect your check, piss off shareholders, and, jeopardize goodwill. You can actually put up and do what you say you're going to do, grow the portfolio, double the portfolio size, double the dividend. Next thing you know, you're in the S&P 600, the mid-cap 4, the large 500, because you did all the right things and you grew organically. Like, that's why are some of these companies have been around for 60, 70 years versus the guys that fly by and they're gone in a day or 2 days. You know what I mean? Like this, a good story will resonate for a long time.
Yeah. So the anti-bad advice is to learn from what happened before.
I wish I had one specific example for you, because I don't want to say it because I'm afraid the person will be watching and it's going to come
I
back
think
and bite me in the butt.
get a new job in 5 years is a pretty good one. We'll stick with that if that works for you.
Sure.
Well, okay. Before we wrap up, before I get all your socials and everything out there for people who want to get in touch with you, do you have any other parting words that you really want to impress on Crexi's audience?
I think, again, REITs are just a tiny portion of the world of commercial real estate. Commercial real estate is not going away anytime soon. It's going to continue to grow and evolve. The landscape might look different 10, 25 years from now versus what it looked like 10, 25 years ago. But there's always an opportunity to evolve and educate and to focus on the big picture that we need these properties. These properties are not going away. We need more. We need more resi. We need more, storage. We need a lot of this stuff that we don't have. And we're still in the early innings of some of this stuff when you look at AI, towers, data centers, look at how your cell phone has evolved, all these different things that real estate is here to stay. Embrace it.
Absolutely.
Buy REITs.
Buy REITs. We're long real estate, especially here at Crexi. David, thank you so much for joining us. This has been a lot of fun. I have so many thoughts percolating in my head that we'll talk about offline just because there's not enough time in the studio. But where can people get in touch with you? We mentioned your newsletter earlier. Definitely plug that. Where can they reach out to you?
So Hoya Capital, the home of our REIT research, hoyacapital.com. You can find us on Seeking Alpha. Happy to discuss that further. The REIT Beat, thedailyreitbeat.com. Find very accessible on LinkedIn, on Twitter at Daily REITbeat. We are very out loud and proud with our content, so it's not hard to find our daily, weekly, quarterly posts on pretty much any platform.
Love it. Awesome. Thank you so much again for your
Shanti.
time.
I really appreciate it.
Yeah, of course. And thank you everyone who tuned in today. If you enjoyed this episode, please don't miss the next one. Visit crexi.com/podcast to sign up to get the next one delivered straight to your inbox. You can also subscribe to the Crexi Podcast on your favorite podcast app, or check out our YouTube channel for video recordings of each and every episode. Take care and be sure to tune in next time.